Daksha Baxi, founder, SRI Solutions. So, ma'am is a highly recognized tax advisor in India, acclaimed by global ranking agencies such as Euromoney, International Tax Review, Who's Legal, Legal 500, Chambers and Partners. So, she was named among Asia Business Law Journal's top 100 professionals. Beyond her professional expertise, ma'am has promoted global peace through meditation and spiritual education worldwide. Her professional mantra is to help clients achieve their goals efficiently and legally. So, with an extensive experience in domestic and international transactions, ma'am has co-authored India's first ready on international taxation and cross-border transactions published by Taxmann Publications in April 23, serving as a guide for understanding taxation in cross-border transactions. So, very warm welcome, ma'am. The platform is all yours to begin.
Good morning, all. Very welcome. Thank you very much, Ridhima, and very warm welcome to everyone who is joining this fantastic initiative taken by Taxmann. It is amazing. In my old days, we never had such a wonderful, insightful webinar available to us, but I am so glad that today it is possible. Along with all the digitalization that is happening, this is something, and sharing of knowledge. As you share it, it increases. So this is wonderful. And I am really delighted to welcome everyone. I'm just going to share my presentation today. And there we go. And we will start the session. It is amazing that you all are going to be listening to more than 12 speakers, having special knowledge and understanding in their own areas of expertise, and analyzing in detail the budget provisions to give you an insight into how those provisions are going to work so that you can implement in your life, advise your friends and clients, and take it all forward. And hopefully we will all together be able to do something really nice with this budget. I will break down my introduction in preview, introduction, overview of major direct and indirect taxation. I'm not going to go into the details of any of the tax provisions. This is going to be taken on by the people who are going to be taking the sessions later on. So as Ridhima said, on 23rd July 2024, the Finance Minister, Mrs. Nirmala Sitharaman, presented the Modi 3.0's first budget, 7th of hers in a row, which is a history on its own. This budget is in the backdrop of the results of the closely fought elections recently. Though the people have returned Mr. Modi to lead the country as their prime minister again, since his own party is not in absolute majority, and the majority is that of the pre-poll alliance partners and that partnership called NDA, it was expected that there will be coalition pressures and it will be a populist budget. It is a great relief and immensely commendable fact that the finance minister in the leadership of Mr. Modi has stayed clear of populist measure and given a well-balanced budget. Having said that, I must add that I do believe that Mr. Modi really, really is a socialist at heart, though he knows how to balance it. And he knows that there is no growth of a country without having large, huge industrial establishments, and that can only come through private investment. So he really knows how to balance, and he therefore guides his entire cabinet to work in that direction. It can be said that it is a budget with elements for continuity of the policies of the Modi 2.0 government to build on what has been done in the past 10 years. This budget needs to be evaluated in the backdrop of other following aspects. One, the global economy, though has performed better than expected, is still in the grip of uncertainties. Many countries are still struggling to come out of the pandemic shocks. We have two wars going on, which have polarized the world and have created disruptions not only in supply chain, but also impacted the ability of countries to contain inflation, which results in reduction in purchasing power. And this consequently impacts the export growth negatively. The determination of the government to become Atmanirbhar is showing shoots of good results, but there is a long way to go. The plan to make India a preferred China plus hub for manufacturing and other economic activities faces huge headwinds resulting both from domestic and global challenges. Fortunately, Indian economy is a bright spot in the midst of the global concerns, as it is the fastest growing economy with buoyancy, both in terms of the gross domestic product and net revenues of the government. As stated by the Finance Minister, the budget proposals aim at sustained efforts on the following 9 priorities for generating ample opportunities for all. And these 9, though already stated in the budget speech, I would like to recount them as a backdrop for all of us to understand the policies that the government has put out, both in terms of how they are going to spend their revenue and how they want to fund their spending through collection of taxes and, of course, other revenues that they expect from dividends, for example, from the Reserve Bank of India. These 9 elements are productivity and resilience in agriculture, employment and skilling, inclusive human resource development and social justice, manufacturing and services, urban development, energy security, infrastructure, innovation, research and development, and next generation reforms. To my mind, these are very well thought out priorities in terms of taking India forward to the next stage in its march to development. The government is focused on the long-term goal of making India a developed economy. While there is a long way to go, the work must be done on several fronts, and it can be said that the beginning has been made. If we review what has been done in the last 10 years of Modi administration, it has strived to do a lot of groundwork. The basic groundwork involved providing the roti, kapada or makan, basic sanitation, water, and power to the bottom of pyramid. Without lifting these people out of abject poverty, no progress can be made on the goal of becoming developed. And to a great extent, all of this has been achieved. The government statistics show that 25 crore people have been brought above the poverty line. Perhaps a lot of it can be witnessed by us all to some extent when we just look around. The programs and allocations made to various schemes in this budget strive to build on what has been achieved over the past years and attempt to accept and incorporate several of the suggestions made by stakeholders. The public spending on building infrastructure has been kept sustainable, since that is the backbone of any economy to grow. Unless we have proper infrastructure, unless we have the ability for our manufacturers, for the producers, whether small scale, large scale, or even cottage industries, to be able to send their ware quickly to the marketplace, there is no way we can grow. There is no way they can carry on business at a sustained level. So this is something which is extremely, extremely important and actually a backbone. Likewise, a whole host of welfare measures for the bottom of the pyramid have been proposed. The budget has a significant focus on employment, skilling, and support for medium, small, and micro enterprises. A slew of measures have been announced to implement schemes for industry to create more jobs, for making youth employable by skilling them. Just because we have demographic dividend, the only way we can reap the dividend is by ensuring that the youth of the people of the country is able to deliver the skill set that is required for them to be productive. And that requires a lot of skilling education, which at the moment, unfortunately, is not provided by neither by our schooling system nor by our universities at the level that it is required. So therefore, the youth which is already out in the job market and is more or less unemployable needs to be skilled. And therefore, several projects have been announced, several measures have been announced. These include both financial and policy-based support. And this is, as I said, critical step towards addressing unemployment and underemployment, ensuring that the workforce is equipped with the necessary skills for the future. There is clear commitment to policy continuity, economic reform, and addressing pressing socio-economic issues such as employment generation, rural and farm distress, and overall economic growth. The finance minister needs to be lauded for remaining and having allocated all of these things without being lured into giving populist measures. She needs to be lauded for remaining on the path of fiscal prudence, despite a lot of pressure on including populist measures. The commitment to reducing the fiscal deficit to 4.9% from 5.1% in the interim budget, with a few further target of 4.5% for the next year, reflects a prudent approach to fiscal management. I will now walk everyone through some of the major direct tax propositions, which I'm only going to mention for everyone to be prepared to receive more detailed discussions on them in the subsequent sessions, which you all will enjoy. There is a commitment to make tax administration simpler and expand tax base. To this end, it has been promised that the current Income Tax Act will be replaced with a new tax code. This new tax code is intended to make it simpler to understand, apply, and implement, and reduce tax litigation, as well as provide tax certainty. While the promised simplified tax code is at least 6 months away, the finance minister has spearheaded some direct and indirect tax measures, which will be discussed today, as I said, in the subsequent sessions. And I would just like to give an overview of what is proposed. First and foremost, and a very glaring one, is an overhauling of capital gains tax regime. Let me let me assure everyone here that this was an ask from all stakeholders for a long, long time. The new regime becomes effective immediately, that is from 23rd July 2024. FAQs to clarify what these changes are and how they work have been issued. The change in capital gains tax regime is explained by the FAQs as follows. And these are the major aspects of this, this policy change, regime change. Holding period has been simplified. Now there are only two sets of holding periods. One, more than 12 months for all listed securities to qualify as long-term capital asset, and more than 24 months for all other assets to qualify as long-term capital assets. This replaces the maze of different holding periods for different classes of assets. When I was writing my ready reckoner and I was listing down the various the holding periods required for various assets, I was just thinking that having practiced this for such a long time, if I find this to be such a maze, I don't know how the taxpayer himself, especially a person who is investing in India, would be looking at it. It gives me a great joy to know that this has been streamlined to bring just to two holding periods with just the two sets of classes of assets. Rates have also been rationalized and made uniform for majority of assets. Indexation has been done away with ostensibly for ease of computation, but there is simultaneous reduction in the rate of capital gain, long-term capital gains tax from 20% to 12.5% for all long-term capital assets. Now, there is a debate about whether the indexation on real estate having gone is something which is fair or not. But as far as the financial assets are concerned, it would seem that that would more or less take care of by reduction from 20% to 12.5%. Of course, it's going to be a touch and go situation, but at least we now have only one capital gains tax rate. Resident and easier computation. Resident and non-residents are all at par, both in terms of holding period and the rates of tax. Rollover benefits, as were available for long-term capital gains, is still remaining, and it will continue to be available. And this must be noted that almost all developed countries in the world do not have anything like a rollover benefit. India is probably the only one of the world which has this benefit, and this needs to be recognized. There's going to be a huge reduction in the withholding tax rates for e-commerce participants from 1% to 0.1%. This is a big ask that e-commerce participants had, because their cash flow, which is not a huge one, was really getting impacted by the 1% withholding tax, because not only their cash flow was being impacted, but their tax rate itself may not be all that large, because e-commerce participants today could be a very, very small participant whose turnover is no more than 5 lakhs in a year or something like that, but with the potential to be able to grow. So this puts a significant amount of cash back in their hands and increases their ability to participate and grow more. Removal of equalization levy on e-commerce operators. This is something which is not under the Income Tax Act. It is under the Finance Act. And for those e-commerce operators who did not have a permanent establishment in India and whose income was not otherwise characterized as royalty or fees for technical services, were not paying any taxes in India, despite the fact that they were conducting a lot of transactions in India. And so therefore, the income from their operation it was felt that India lost the ability to tax them for income from their operations, their income which accrued to them from India. So as you may all be aware that this has been India's complaint for more than 20 years. And in the last 8 years, India gathered together with G20, spearheaded this movement, and the OECD also joined in, which is called Base Erosion Profit Shift Initiative. And Action 2 of that has been looking into removing this complaint of the developing countries, which are called market economies. A global consensus by the G20 and the OECD is more or less there for Pillar 1 solution, which allocates some tax to market economies earned for the revenues earned from the market economies. While that was being put in place, the developing economies, many of them were permitted to have their own measures to try and protect their tax revenues. And this included imposition of equalization levy, which India did 2 years ago, I believe 3 years ago, at 2%. This is now being removed with the hope and expectation that Pillar 1 proposals will be implemented fairly soon, and India will get its tax dues under Pillar 1 as will be available to it, being a market economy. There are also several reductions in TDS rates from 5% to 2%, putting significant amount of cash flow back in the hands of those people. And these, if you will go through the list, you will realize that they are not necessarily large players who were being subjected to 5% TDS rate. So this is going to really boost their cash flow. A large chunk of government's tax revenue is blocked in tax litigation. We all know that all tax litigation is not necessarily resulting in favor of the revenue department, but quite some amount of it is. And we all also know that a lot of times the tax officers tend to keep going into appeal for something which is extremely clear that the law is in favor of the assessee. And this all clogs up the tax revenue in litigation. So in order to remove this backlog, again, the government has taken 2 measures. One, it has brought in another Vivad Se Vishwas scheme 2. I'm sure people will talk about it later in the sessions. And the second one is that there is an increase in threshold of disputed tax for the department to appeal to the higher forums. Lower taxes are sort of, given to salaried people. Salaried people have been asking, salaried people, quote unquote, middle class, have been asking for some relief measures. And this has been done by lowering the taxes on them through the new tax system. The slabs have been changed. There is an increase in standard deduction and increase in the deduction available for contribution to NPS. One of the other things which is also very, very important for putting cash back in the hands of salaried people is that if the salaried person has been subjected to TCS, then that TCS will be available as a credit against the salary, the TDS of the salary of the salaried person. This should really put some amount of cash back in the hands of the salaried person. With the intention to provide more impetus to domestic tourism, especially through waterways, a new presumptive taxation regime has been provided for the non-resident shipping companies operating in domestic cruises. Another loophole that the government has tried to plug is that it is with respect to what is popularly being called the buyback tax. Now, when the system of dividend, taxing dividend changed from dividend distribution tax on the company to a tax being levied on the shareholder at the applicable rate to the shareholder, the provision for buyback under Section 46A did not change. And this was used and in the language of the Revenue Department, misused. What I would call it was arbitrage. The large shareholders did not take dividends, especially this especially applied to closely held companies and companies which were held by non-residents, and most of those companies which had large promoter holdings, etc. Not too much for the purposes of taxation by listed companies, though also by them sometimes, but mostly by large unlisted companies. And what happened is that the company was buying back the shares from the shareholders, and whatever consideration was being paid to them was characterized as capital gains. That is, the consideration minus their cost of acquisition was characterized as capital gains. In most cases, it would have been long-term capital gains, and therefore the tax being paid was much lower. At the same time, what the company was actually doing is using its accumulated profit to distribute to the shareholders. That is what actually was happening in reality. That was a factual thing. So this is now being changed. Now the entire consideration being paid by the company will be taxed as deemed dividend in the hands of the shareholder. Shareholder will be given a reduction, a set-off for capital loss that has been incurred for the surrender of the shares. So this is something which is a new provision and a very, very far-reaching provision. Now it is also proposed to have withholding tax of 10% for any payments being made by a partnership firm to partners. This includes their salary, remuneration, interest, commission, etc. payments. Now, that there is going to be some issue with regard to salary, especially, which is normally treated as part of the profit distribution to the partner. So how this credit will come in their hands is something that the speakers who deal with this provision through the day will be dealing with. Another provision which is very interesting is, as we all know, Section 56(2)(10, we all call it introduction of gift tax from the back door. What it really means is that only when the gift is received from a relative or it is a transfer to a trust, a private trust set up by a person for the benefit of his or her relatives, then the recipient was not taxed on the asset being received, on the value of the asset being received. In all other cases, any person receiving gift of any nature would be taxed if the value of that gift was more than 50,000, including a transfer to a private trust by any person for anyone else. This was there in Section 56(2)(10, or it has been there in Section 56(2)(10 ever since this section has been expanded in its operation. However, the exemption that was available in Section 47(3), Roman 3, was not changed. That exemption was that any person making that when a person makes a gift or transfers any asset to an irrevocable trust, which is not a private trust, as I said, for the purposes of the person's relatives, then that transaction was not treated as a transaction which was subject to capital gains tax. It has now been both these sections, Section 56(2)(10 and Section 47 Roman 3, have been aligned. Now, Section 47 Roman 3 says that gift or will or inheritance or transfer to an irrevocable private trust are only exempt from being treated as transfer for capital gains if that is made by individual or HUF. All other parties will be subjected to being treated as having transferred, and capital gains tax provision will be attracted. This could result in taxation being levied both on the transferor under Section 45 of the Income Tax Act and on the transferee under Section 56(2)(10 of the Income Tax Act. Double taxation. I'm not entirely sure whether this is with intention, but it seems to be that this is something that the government wants to discourage. An important amendment also is made in respect of charitable trust, in that a merger between two charitable trusts where both of them are charitable will no longer be considered to be converting that conversion of the transferor charitable trust into a for-profit entity, and hence it would not attract the exit tax on the assets transferred in the hands of the transferor trust. I now briefly talk about the indirect tax provisions, which are large in number, but these changes are mainly focused on promoting domestic value addition, reducing trade bottlenecks, curbing litigation, and improving the ease of doing business. A key proposal is to comprehensively revamp the customs duty rate structure over the next 6 months. And the proposed amendments to the GST laws are largely based on the recommendations from the recent GST Council meeting. I am happy now to hand over to Ridhima, who will introduce the next speaker and take you through all the finer details of direct and indirect taxation.
Thank you so much, ma'am. You actually set the tone right with all the comprehensive analysis at one stage. Thanks a lot. Before I we let you go. Just one couple of questions we had. Can I take that?
Yes, please, go ahead.
So I just wanted to know, since we are talking about an overview of the budget, and we saw that Finance Minister clearly told that she will be simplifying the income tax provisions further in the next 6 months. What major change you see coming specifically in income tax when she says simplification of the income tax?
Well, this is like gazing in a crystal ball. To be very honest, everyone is very tight-lipped about it, and it would be preposterous on my side to try and understand it. But what I would expect is that currently the Income Tax Act is like, extremely patchy. If you
Right.
want to figure out what is the tax provision in relation to any particular transaction, situation, or person, you have to, refer to so many provisions. Even the section itself says so and so as referred to in another section. So you have to go to that section. That section takes you to another section. Then there is a proviso somewhere, and then there is a rule somewhere, then there is a
Correct.
CBDT notification somewhere, then there is a CBDT circular somewhere. So that whole maze is making it extremely complicated. And what happens is, a lot of times in their desire, the taxpayer in their desire not to pay up more than what they should be paying, and the tax advisors in their desire to help the clients to achieve that, end up advising something which may be missing out on something. And then again, you have Supreme Court ruling on certain aspects which may be very, very different from the interpretations that everyone else has had, and an interpretation also from the plain reading of the provision. So there is a huge lot of complexities, which and what happens is, as soon as Supreme Court rules in favor on a particular provision, interpreting a particular provision of law in favor of as a taxpayer, then the tax department feels like they have been cheated. They really
Yeah, you've
wanted
been
to
wrong.
tax that, so they want to make the change. And in the next budget, they bring in that small little change to overturn that Supreme Court decision. And what happens? That creates a lot of complexities or anomalies or contradictions. So this is the kind of one case that I would like to mention here is Shikawa Jima Harema, where the fees for technical services, it was an amazing decision. To my mind, with all due respect to the Supreme Court, maybe they weren't pointed it out properly. They actually referred to the wrong subclause of that section 916. Okay.
Oh,
And what happened? The tax department immediately changed it in the next budget to say that whether you have a presence in the country or not, you will be taxed on such
yeah.
and such a thing. Now that doesn't happen. That doesn't get translated into to non-residents being taxed, because non-residents are eligible to double taxation avoidance agreements also. Okay, so they won't go by the Income Tax Act, but that's what happens. But that has made the Income Tax Act more complicated. So this is what has happened. So I am assuming and hoping that those kinds of situations don't arise. The drafting is done in a well thought out manner, and the rules are also made which are consistent and not contradictory. If you see
Correct.
the valuation rules, there are valuation rules all over the place. For one type of section, you have one valuation rule. Another type of section, you have another type of valuation rule. And when is that rule to be used?
Complexities, right.
It's a very complex. That is one of the things where the indexation benefit is being removed, because that was also causing a lot of
A very controversial one. I guess it
yes.
would be a hot topic today
Yeah.
throughout each session. Great, great, great. Thank you so much, ma'am. It was a pleasure having you.
Thank you.